It's time to talk about how enterprises can enter the startup game and unlock significant value for shareholders. In this video, I want to talk about the methods, the options that you have for entering the startup game as an enterprise, be that direct or indirect. I want to talk about why it makes sense for you to do that, what some common problems are that you are going to experience if you do it, and a case study that should help you think through options for how you can navigate these problems and learnings from my 5 years of doing this, where I will tell you about problems that we have encountered that have held us back in our corporate venturing exercises and things that ultimately made it work and turn it into a huge success. All right, having said that, let's jump right into it without further ado. In terms of methods for entering the game here, you have indirect and direct methods. I'm a huge fan of the direct one, but there is also merit for the indirect ones. So what are the direct options? You got venture creation, so you on a greenfield, you build a new company from scratch. You likely will have to deploy capital and talent from your organization to that venture, and then have them, figure it out on their own or with support from central services. Strategic investing is that you go into rounds. You need a scouting team, you need a diligence process, you need potentially an investment committee, or at least have that at some level of abstraction in order to then directly invest startups, and you then also need portfolio management capabilities. And then thirdly, you need to, or potentially as an option, you could just outright acquire startups, whether they have certain customer relationships, IP, or data that is interesting for you. That is all a reason to acquire a startup. It could also be just a talent, to be honest. Then indirectly, you could become a limited partner of a venture fund. Many enterprises invest in venture funds along with, more traditional wealth managers and institutional wealth managers. You could also partner with startups. I think this is the one in the indirect category that I'm particularly excited about because it's a win-win for startups and for enterprises. Startups get revenue, cash flow, the validation of working with a large enterprise. They get connections within the organization, while they would usually kind of get lost in the sales process with a large enterprise just because it takes time and organizations change and startups are not really made for enterprise sales. And the enterprise gets exposure to the startup, understands how good the technology is, learns and meets the team members, and also just starts to figure out how startups work. Even if you don't end up investing in that startup or acquiring it, it at least gives you that initial exposure, and that's where startup partnerships can come in. Deloitte, for instance, recently acquired a vendor in this space that helps with specifically startup partnerships for enterprise. And then there are accelerators and incubators that you could support through cash or some other kinds of support mechanisms where you may have exposure ultimately to the equity that these accelerators and incubators may be getting from startups. Or at least it's a scouting mechanism for you so that you can see what the trends are in the industry that you're in and either develop your own products and solutions before startups can really do that, or partner with startups in whatever fashion that would be. Now, why do these forms of these strategic options for you to go out and venture as an enterprise make sense? Well, it starts with just the pure shareholder value that startups create. If you sum up all the market cap of startups, you will be not in the billions, but likely in the trillions. That's shareholder value that your shareholders want you to capture. In addition, if you look at some of the large, more mature technology companies nowadays that have created even more value for shareholders, most of those are previously fledgling startups. Be that Tesla, SpaceX, Amazon, Apple, even Nvidia, Epic, all of these companies are formerly startups. And so as a matter of fact, at some point, your own organization was in some sense a startup back in the time when it got started by your founder. Every business has an origin. The second point is that it helps you potentially time that your current products are approaching the end of their life cycle and get you a new set of products as that happens, so that you're still relevant, that you're still on top of what consumers and changing consumer needs are, or customer needs, and that's where new startup R&D can come in. Thirdly, and I think this is potentially underestimated or underappreciated, is that exposure to startups gives you exposure to new ideas with regard to go-to-market motions. Most enterprises rely heavily on inbound, rely heavily on cold sales and sales in general, do a little bit of marketing on the side, but are really not good at anything other than sales. And that's where startups can come in and share some of their experimentation capabilities. It's not necessarily even knowing what works and what doesn't. It's just having to go through that cycle of testing, failing, testing, failing, testing, failing. That should also be interesting for you. And then lastly, I think some enterprises, or an enterprise that goes out and engages with startups, is just a more exciting place to work for, especially for the younger generations. If you were to ask me whether I want to work for an SME or an enterprise that doesn't engage in venturing and just does its old traditional legacy thing, I would just not be as interested in that, versus if you tell me, hey, we have a corporate venturing team, or we have a partner, an outside partner that helps us doing this at scale, then I would get excited about that and could consider myself having a career at that company. Now, what are some common problems that you will likely anticipate or likely experience as you start to venture out as an enterprise? From my experience, it's usually a set of 4 major categories, but there are probably more reasons or problems that I can mention and can creatively think about here. The first one, in my opinion, is conflicting priorities that you somehow have to sort out. If you want to do enterprise venturing or corporate venturing, you will have to allocate resources. And you will have to think long-term. Things will fail, will take more time than you anticipate, will cost more money. For especially publicly listed companies, kind of hard to do that when you have shareholders that want to see short-term results, dividends, margins, revenue improvements, whatever it is. Startups are not really the solution for solving for these short-term changes and requirements. And you also, as an enterprise, obviously need to continuously invest in your core business, not necessarily just in new innovation, which means R&D budget is limited. Where is it going to go, right? It has to be balanced in some way, and that's probably a challenging discussion that needs to be led by the top. Now, the second one is immune systems of organizations. This is similar to my experience selling into enterprises. Organizations change all the time. Politics internally change. It's just very hard for individual leaders, especially in the middle and lower end of the organization, to kick off something like this. It would just needs to come from the top. And even then, there will be change management implications where people will be afraid what this means, that you're now going out to venture. And if that's not properly communicated, it doesn't help anyone. And then in addition to that, obviously the immune system also includes bureaucratic processes. I don't think necessarily these are bad, because the processes are what in the first place enable your organization to get to this, to this level of size. But ultimately they could be a roadblock as you try to innovate, as you try to become a disruptor yourself. So these are initial 2 problems that I'm seeing, have I experienced and anticipate. And then the third one, and that's very familiar to me too, is just limited entrepreneurial experience. There is sometimes this assumption that top executives at large enterprises are qualified to engage with startups and build startups from the ground up or invest in them, but that's just not true. The skills that are required for finding product market fit, for hustling your way to go to market and raising additional capital for your business are nothing compared to what you would need to do in a large organization where most people are very specialized, focused on their specific thing, and are the best in the world at that, but nothing else. I'll talk about this specific issue in a little bit too in the learnings that we have made from this case study. And then the last one is that you don't have the right connections. How are you as an enterprise going to be a credible partner for startups if you don't speak the startup language, because you don't have the entrepreneurial experience, you don't necessarily know where to find them, and startups have sort of question marks in terms of whether or not they should partner with you. For instance, one common concern, especially in strategic investing, are 2 actually. The first one is that startups will think that, hey, now I have a competitor on my cap table, on my capitalization table, so my ownership structure. And what does that mean for my ability to partner with additional companies in that space that I'm building for? They may not like that partially I'm owned by a competitor of them. And the second one is that venture capital investors will potentially think, hey, now that they have a strategic investor on board, do they still have the same growth ambitions that I would want them to have in order to go and become a unicorn and go public on the markets or get acquired in a mega deal, versus the strategic acquirer potentially just wanting the technology to get a little bit better and then integrate it into their own business at a reasonable price point, potentially even acquiring the business at as low as possible price point. So all of that is in somewhat of a messy, not the right connections category. It's actually a couple of different subpoints that I should probably break out, but that's what I mean here. And then there are other problems. Again, can't think of all of them, can't mention all of them here, but one, for instance, could be just, hey, you're overwhelmed, you don't know where to start, you have no vision for the company at large. I'm always surprised at how poorly articulated most visions, missions, and strategies for enterprises are. And if you don't have that in place, how are you going to develop a corporate venturing thesis? That is challenging, and you probably need some consulting around that. Now, in terms of case study, I, as mentioned, spent 5 years doing this. I was a principal at a company that primarily was active in the healthcare space, specifically in biopharma and in healthcare technology. At that company, we built 35 startups. Our organizational setup was such that we had a topco. Let me get my hand right here. We had a topco on top, and then we had different portfolio companies, these 35 startups, some of which we built Greenfield, some of which we acquired, for some we invested, for some we did licensing deals, all kinds of activities to create that portfolio of companies. That's what I mean by portcos, portfolio companies. It took us about, not me, I wasn't there for 7 years, I was there for 5 years, but the company overall about 7 years to build this portfolio, and ultimately had multiple IPOs on the New York Stock Exchange, the NASDAQ, multiple exit and mergers, and raised billions in capital from investors like SoftBank Vision Fund, Founders Fund, Palantir, and then ultimately, as we became larger and larger, also strategic and financial investors like institutional wealth managers, as you would do when you go public, for instance. The company, if you're curious and want to learn a little bit more, is called Roivant Sciences. I was in the Roivant Health team at the end, but I was also on the Roivant Pharma side, which is the biotech and biopharmaceutical side. The Roivant Health side is the healthcare technology side. Alrighty, and let's continue on this path a little bit more. What we did essentially, when I mentioned we had the topco and we had the portfolio companies, the portcos, I need to figure out where to put my hands a little bit here. Essentially what the topco was responsible for is incubation of new companies, whether that's Greenfield, acquiring, investing, licensing. And we built a repeatable playbook for doing that. The first part was that the topco offered certain functional support for the portfolio companies. From, just how do you set up the legal entity, to financial planning and accounting, to strategic finance if the portfolio companies wanted to do acquisitions or needed to raise capital in addition to what we gave them. They may want to have legal questions, HR questions, IT questions. We had all of these shared services as you would have in a larger enterprise at the topco level. And then we would, in addition to having that functional support, we would also have employees from the topco drop into the portfolio companies and help operationally with anything that was necessary. That could be, again, from recruiting to growth to setting up technology, infrastructure, processes. But it was important to establish in our heads this perspective on that there is a strategic and legal difference between the topco and the portfolio companies. They are not departments of our business. They are individual entities that we may at some point even sell. And I really like this sort of family of companies approach that we took, where we had the central support system with a playbook that was repeatable, and then built that into 35 startups. What we also did, in addition to just sending out people that would support and the functional support and central services, we would also offer them valuable assets and incubate them with these assets. Typically, that took one of two forms. One, it's either data, where, especially on the healthcare technology side, that data is extremely valuable and usually inaccessible for startups. In our case, we either had vendors from which we could get data, or we had our own data from our own business activities that we could incubate the business with and give them a strategic advantage on the market from day one. Analytics and data are just gold for startups. The second one is partnerships. We had a certain negotiation power as the central entity that raised significant sums of money, and across the portfolio of companies was very substantial in size. And so we used that negotiation power to forge partnerships with partners that the startups were interested in. That could be anything from a channel partnership to a customer relationship that they would get started with. And that's invaluable for startups that otherwise just struggle very much in the beginning. Now, at the portco level, at the portfolio company level, what we did is that every startup had its own dedicated management team that was fully responsible for operations of that business, that was incentivized via significant stock options and obviously also in that case salaries, since they're not traditional founders. They were not founders, they were CEOs and CXOs and VPs. And The key is, again, responsibility is with the startups, but they can leverage certain central services. Now, that does lead to certain knock-on effects that I want to talk about in a little bit, but overall, the split between topco and portcos has worked well for us, as evidenced by just what this company achieved. Now, what did we learn? What are some problems that we had, and what are some of the things that made the entire thing work? The problems that we had, I think it's just natural. Startups are going to fail, and we had a very high failure rate of our startups too. And on top of that, even though we wanted to achieve things very quickly and scale as crazy as possible, it takes time. Any investor will always be looking for sort of this hockey stick revenue curve, but honestly, it's just not. It's delusional. You have to give things time to grow. You have to give things the time that they have a fair chance at actually succeeding. And so it's an obvious one. But if you try this on your own, or if you try this on your end, you will just need to give things. You will have to have this failure culture. Then the second one is, and I think this is a big one, is that we were pretty shitty, I think, at finding the right talent. We had the assumption, and this wasn't necessarily my decision, it was just a company policy to some degree, that we would bring in top executives from top companies, including large pharma companies, large healthcare companies, large consulting firms. It could be Novartis, it could be Parexel, it could be McKinsey and Boston Consulting, and deploy them as the leaders of these startups, as the CEOs and whatnot. And honestly, the gap between a good entrepreneur and someone who is working in a line function is just so big that that, in my opinion, for everyone that I worked for, that I supported, that I saw, utterly failed at being a good entrepreneur. So the only cases where it really worked for us was when we had people that were previous founders, or at least had significant startup experience running these companies, or if we brought in generalists that were sort of the principal type of level or the associate type of level, not necessarily to lead the company, but to support it at least. That turned out to be better. What that also avoided is the type of cash burn that you get from hiring or placing top executives in these new companies, just because they cost too much money. They have a totally delusional perspective on how much you can spend on consulting fees, technology, and stuff like that. And before you notice, all the cash that the company was incubated with has just been burned, and that's not a viable approach to venturing. Then the next one is analysis paralysis, a catchy term here. For us, it just in some cases took too long to decide, hey, are we buying this company? Are we investing in another company? Are we doing this licensing deal? We would screen the horizon for relevant startups forever. And at some point, as we potentially, for some of our startups, used to buy and build approach that you would know from private equity, the company just ran out of cash. After 50 different iterations on which type of acquisition or which type of other startup that we could plug into that startup, the company just didn't have any cash left to continue going, and we didn't feel like it made enough progress to put in more cash. And then the next one, aside from, it still failed, it still took time, we didn't have the right talent, the analysis paralysis, is an incentivization issue. When you bring in someone as the CEO or some kind of C-level role into a startup, and incubate that startup with valuable resources, including cash, including essential services, and including data and partnerships, you just cannot give them the same type of ownership in that business as you would give a founder, or as a founder would have in a regular startup. What that means is that these executives, the leaders, in our case, just weren't as incentivized and weren't working as hard as founders in other cases would. And for external investors, in some cases, we wanted to bring external capital just to validate our business idea through the lens of additional venture investors. We saw that some of these external investors had hesitations around, are these leaders really appropriately incentivized? Is that something that I want to engage with? The next one here is competitive considerations. Mentioned that a little bit earlier already. I'm not quite sure where it was. It was probably not the right connections, but we did see that we as the topco were considered competitive for some of the potential customers of our startups. So that's another issue. And I think this is a critical one. We saw pretty strong, especially in the beginning when we put up this governance model and this organizational model, we saw pretty strong overlap. And in some ways, it was also by design intentional. Strong overlap in functions available at the topco and in functions that we would build out at the portfolio company level. By functions, I mean functions like HR, finance, growth, IT operations, whatever it is, which led to duplications of roles and ultimately just higher cost. We found a solution for that, and that's the first one that I'm going to mention, and factors that made it work. Ultimately, we went from a more centralized setup to a very decentralized setup, where we said, hey, central services are going to be focused on very specific items. The rest you have to do yourself. Ultimate responsibility is with you. What happened before that is, again, in addition to the overlap in terms of cost structure, we also had just too many cooks in the kitchen. Legal decisions, IT decisions would take forever. We would see that startups in our portfolio would say, hey, this is not our responsibility, or I'm trying to get some feedback from the topco and it's taking forever and I can't play like this. Or we had endless politics. So decentralized, really making sure that in the mindset, you recognize that these startups are separate entities, even better if they're actual separate legal entities and not just teams. And they get their resources, they have to figure it out themselves. And maybe you accept a little bit of overlap in terms of function because they built out these functions as well. That's the best way to do it, I think, just because centralization is never good. And I'm not necessarily a Web3, a blockchain advocate here. It's just happens to be a better organizational and governance structure. The next one that made it work is that we frankly had the capital to take risks, which means we were okay with a failure culture. No one would necessarily immediately get fired for failing. They would potentially just be making less fast progress in their careers. But ultimately, we for a corporate, we were fine with failing and had the capital to invest in failing. And in addition, I think we did somewhat of an arbitrage model where we would have very strong investor connections in the US, raised capital in the US for bullish valuations, high amounts of money, including our IPOs, and then deployed that capital globally and used talent internationally. Good. And then the third one is just purely long-term thinking. I mentioned conflicting priorities earlier, where you may have, certain short-term revenue and profit pressures because you're a publicly listed company. In our case, especially while we were still private, we were able to stay true to our mission, focused on the long-term goals that we were pursuing, and that just let us give startups the time that they needed in order to mature and succeed. Next one is that we were creative in deal making. We were always thinking about, hey, what is it that the other person on the other side of the table is looking for, and try to give that to them while not giving too much up of our benefit from a potential deal. That is in terms of the mentality, but it's also in terms of the pure mechanisms that we used for building our startups. We used creation, we used investing, acquisitions. We did a whole range, including licensing deals, all kinds of things just to make deals successful. And then ultimately, we also continuously iterated doing what we were doing, right? When we first started this, we didn't know what the best governance and organizational model is for venturing out as an enterprise, but ultimately by trial and error, by changing the business model, by going through the pain of also what it means to reorganize the entire process, we were able to again, achieve the successes that we had. All right, that's been a pretty long video, 23 minutes we are at right now. Hope you found this useful in terms of some learnings, approaches, methodologies, and issues that you may run into in terms of enterprise venturing. If you have questions, drop them in the comment section below. I'll be happy to get back. If you enjoyed this video, make sure to leave a thumbs up. It's great for me to see what kind of content is more interesting for my audience and listeners and viewers. And if you want to stay in touch and just up to date with regard to the content that I publish, definitely make sure to follow the channel on YouTube. I would find that awesome because it's great for content creators. And I pour my heart into this, so I hope you appreciated it. Fantastic. And if you don't, then dislike the video, leave a comment that you didn't like it, and I'll get back and keep the learning cycle going. Perfect. Hope you found this useful. Have a great day. Talk soon. Bye-bye.